The bottom line is we import so many more goods from China than they do from us. So I think there's a lot of room to move there from a concession standpoint. And also, I mean, you look at all the small cap stocks are hitting all-time highs right now. It's just because they're not dependent on being overseas for, whatever they need in their supply chain.
Do you chase that trade?
No, definitely not. I mean, small caps
too expensive?
I think you have to have them in your portfolio for a proper asset allocation, but that's not the buy of the day right now. If you look at valuations on small cap stocks right now, they're extremely, highly valued versus other parts of the market.
So you do what instead?
I think you got to be global. I think you have to have commodity exposure in your portfolio. You need to own the foreign markets as well, because all that stuff on a valuation standpoint is a lot cheaper, and tariffs are keeping that stuff down in price, which to me is a good buying opportunity. Jason, what do you think?
I agree that I think what we're seeing in China is a reflection of the divergence of the impact of trade. So U.S. could be a little more resilient. The fact that small caps have done well here, high yield, especially kind of lower rated, single B, triple Cs have done really well. That suggests the market's not too concerned about U.S. growth at this point in time.
Should it be?
Given what we know in terms of trade implications right now, it shouldn't be. The risk is escalation, and I think that's what you're seeing, why China's selling off more so than we are, because we know the impact will be greater there. In addition, since the spring, once Xi kind of consolidated his power, there's clearly a move to try and deleverage some of the banking system. They're trying to slow growth. So you take that already kind of slowing momentum, add on top of these uncertainties. In Chinese equities markets, where it's a little more illiquid, that's sort of a bad storm for them. That's kind of why I think we're seeing the bear market there.
So the risk is escalation, as you say, but we talking about China. I get the market's lower, but are we focused on the wrong thing? I would submit the market's been sort of skittish since that Fed meeting a couple Wednesdays ago when they talk, in my opinion, a bit of a hawkish tone. So my concern all along has been, listen, I'm not saying it's a Fed misstep. They should probably be hiking rates, but is the Fed in the conversation again? Is that the real threat to the market?
I think for the time being, the Fed is almost out of the equation, because if you look at where the rates markets is priced going forward, it's priced for the Fed raising rates 2 more times this year, early next year. Forward curves indicate that they think the Fed's going to stop around 3%. So right now, it's going to take a lot for the rates to move higher. If that's the case, it really comes down to what does growth do, and if growth is good, equity should be okay.
You're eager to say something.
No, I think that's the biggest misconception. Rates are still low. Even if they hike 2 more times this year, we have modest inflation. It's a gift from the gods. We should be embracing it. Nobody is.
You know who's not embracing it? The XLF, down 12 days in a row here. What if banking can't do well when the economy is hot, when supposedly the Fed is raising rates? What's the problem with the XLF? Jump ball.
Yeah.
So this is an environment where financials should be doing well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.